Good afternoon. So, to the Excellencies, Director General of Ethiopian Capital Market Authority, distinguished captains of the industry, colleagues, and friends from the media. So, at the very outset, I would like to express my sincere gratitude to Ms. Hana Tehelku and her entire team at the Ethiopian Capital Market for organizing a summit at this scale and its significance that brings together a powerful ecosystem of stakeholders, regulators, issuers, investors, and institutions contributing to the knowledge, standard, and capacity building. The scale and professionalism and ambition behind this summit clearly reflects Ethiopia's commitment to building a robust and transparent and globally competitive capital market. This is my first time in Ethiopia, and I must say I'm genuinely surprised by the remarkable infrastructure, the orderliness, and the high level of organizations across various sectors. I was sharing with some of my colleagues and today earlier that being here almost feels like being in a developed country rather than a developing one. So congratulations to the significant infrastructure development that has happened. So it clearly states that Ethiopia is now in a phase where significant capital is required for infrastructure development. Whether it energy, logistic, telecom, manufacturing, or social infrastructure. While public sector resources are there, but they alone cannot meet these needs, private sector participation needs to play a critical role in closing the financing gap. This is exactly where credit ratings become a very powerful enabler. A credible and independent rating framework helps ensure whether sovereign, corporate, or financial institutions accessing funding at lower cost by enhancing transparency, improving investor confidence, and reducing perceived risk. Ratings help attract both domestic and foreign investors and ultimately contribute to lowering the overall cost of capital. And this is where I think a rating agency plays a critical role. So, as Ethiopia depends its capital markets and opens more avenues for private investment, the role of credit ratings in guiding investment decisions, supporting regulatory frameworks, and facilitating long term sustainable financing will become even more important. So, in today's presentation, I will discuss about strategies to develop credit rating culture with an example that how we played a critical role in development of a local currency bond market in Mauritius, our regulatory role, and how our rating agency assesses issuers. So my name is Saurav Chatterjee. I represent the CareAge Group. And just to say who we are and what we offer, we are a 30-year-old rating agency from India and we are the first rating agency from India to set up in Mauritius. We have a sovereign rating from India. We do sovereign ratings. We do ratings across various countries. We do analytics and ESG offerings. I'll move on. This is our presence. I'll just move on in the interest of time. So we have licenses across Africa out of the 3 countries, and we are expanding. So now, before I move into this slide, I want to highlight in this particular slide where you see the bond market of Mauritius. And I haven't captured before December 2016. We set up our agency in 2015. And today we are in December 17. You can see the bond market started growing. One is the rated part, another is the listed part. And if you see the bond market, today we have a 120 billion Mauritian rupee bond market, of which almost 70% is rated by us. And there is no rating mandatory for a bond which is being put up in the market. Now, why I wanted to highlight this slide, I can see where Ethiopia is or what they want to do, where Mauritius was, say 8 to 10 years back. Now, this slide shows that if we can have the proper ecosystem and we can get the right people to invest and we can choose the right issuers, the bond market can definitely grow and flourish. And we are talking about Mauritius, which is a $15 billion economy, of which right now they have access to around $4 billion of funding through the bond market. Now, coming back to this slide, we just wanted to say that what I have seen as the development of the bond market in Mauritius, even when the bond market initially, in the first phase of 2 or 3 years, what we have seen is basically the banks who used to invest in this market. But today what we have seen a shift that from the banking sector to the non-banking sector. And that's where the rating has played a very key role. what the two things what the rating is done. Yes, rating, what when we talk about rating, we talk about a symbol. But more than the symbol, it's the rating rationale. I heard somebody spoke about it in one of the sessions, that it's the rating rationale. I think the Nigerian regulator spoke about it, that it's a rating rationale which has to be disclosed, and that's the rating rationale which is there, which is disclosed. We have rated 100 companies and all the rating rationals are there in our website. So the investor, regulator, anybody want to get access to, they can go to the website. And even we have helped in policy framework with the regulator in Mauritius, where FSC has come up with regulations where they are made that if the bond needs to be issued, if they have to be, they needs to be rated over the if it's rated, and the rating rationale has to be there. This what has happened in this is that the lower the almost zero default, because we have been able to identify the ratings. We have given assessment of the ratings, and the ratings have not has been almost rating default has been almost zero. So that has given a lot of confidence to the investors. So initially, the pension fund, insurance companies dealing with public money were very skeptical in investing in the bond market. But once they saw the stability in the rating, they started investing more. And today we can say 40% of the bond market investment is from the non-banking sector, and slowly that is actually moving. We rate a lot of companies. I can skip that for the interest of time. Now, moving on the regulatory role in overseeing the CRAs, I'd put it that quality and integrity of ratings is very important. Independence, governance and compliance, and regulatory oversight. In short, ISO rules are there. If you need to prepare a framework for setting up for a rating agency, follow the ISO code of conduct. That actually covers everything. Moving on, what are the policies, structural safeguards, employee restrictions, that they should not be investing, the employees cannot, analysts and all cannot invest in the securities where they're rating, because a lot of sensitive information is available well in advance. Mandatory disclosure of holdings, trading and investment rules, transparency, and the regulatory role. And then I spoke about how we can think about developing the market and how we can assess. So when we talk about assessing an issuer, we have to develop methodology optimized in line with the country-specific ecosystem. So here, let me pause and give an idea. We are talking about local currency debt market. When you need to develop infrastructure, and you have, today I see, I've gone through various reports and I found out that the banking system today has a credit to deposit ratio of 68%. So why invest another 20, 25% or 30% in government securities? Why not invest in the projects? And similarly, if the insurance companies and pension funds can invest in projects which are basically backed by government and having strong cash flows. So the primary thing is, if you are dependent or if you are looking to develop infrastructure, it's the local currency which can help you reduce the forex risk and the volatilities. So we have developed methodologies optimized with the country-specific ecosystem, while we have methodologies which are time-tested in India for 30 years. We have fine-tuned it in line with Mauritius, and now we have developed for the 2-3 countries where we have a license, and it will be fine-tuned to the requirement of the country and the ecosystem of the country. Technical assistance for development of local currency bond market, engagement with investors and stakeholders, basically training them. Local currency ratings and rationales can improve credibility and perceived corporate governance initiative. And finally, an ECI recognition under the Basel guideline from the central bank, which will serve two purposes. One, the bank's capital consumption can go down. And the second, if the lending exposure is rated, that can give a signal to the investor who is investing in the banks. I'll just move on to the rating process. We generally do a solicited rating, and only after we sign the mandate, and we have an analytical team who does it. I'm moving on. If anybody wants to speak, they can talk to me. We do quarterly and surveillance. So once initially the rating is done, one important thing is, once we do the rating, it's a committee which assigns the rating. And once we assign the rating, it's there for the client or the issuer to accept or not to accept it. If the client doesn't accept the rating, it is not used, then it remains unaccepted. It is not used it is not used for raising any funding. If it is accepted, then we have to monitor the rating till the particular facility or the instrument is repaid. Moving on. So we do continuous surveillance, but definitely we will do quarterly. We will look into some of the numbers, and every year, once the annual report is there, the rating will be reviewed and a detailed rationale will be published. We rate issuers of sovereigns, credit lines, and everything. This is investors' benefit for the rating. I'll move on. Issuer advantage. These are some of the rating symbols. Yeah, that's it. I'm done. Thank you.
All right, thank you so much, Mr. Saurav. Joining us on the panel today is Ms. Tanveer Nandhra from GCR Ratings. Welcome, and thank you for joining our panel discussion. So the credit rating space is new to this market, so I feel like this is a very timely discussion. And I know there was a lot of mention about developing the debt market, in particular the corporate debt market this morning. So I think this topic goes hand in hand with that. With that said, I'll jump in to the first question and I want to give both of your perspectives on this. Credit assessment in markets with limited data is very difficult. So I want to know, what are the biggest challenges in fostering credit rating culture in developing markets? And for the purpose of this discussion, please focus on non-sovereign ratings.
Thank you for clarifying that. Good evening, everyone, and apologies to keep you. We're in between you and end of day. You know, the African continent is very interesting because it's clubbed as one continent, but very distinct in how it operates. And therefore, what happens in developed markets is typically information asymmetry, right? Many issuers operate with limited disclosures, short operating histories, and we talked about family offices. We said, you know, Ethiopia is a nascent market with 30 years, probably as far back as companies are going back as far as 30 years, and probably some level of inconsistent reporting standards. I think the second challenge really is why a lot of us are here today is around awareness. Issuers and investors may not fully understand how ratings work or how they add value. And I think I was sitting at another forum where we keep talking about the issuer, but it's also really important to understand what the investor is looking for. And when we had the session around pensions, what are the things that, you know, investment policies are made up of? How do they assess risk? So I think those are some of the things that miss in terms of connection. And then I think finally, the markets lack comparable transactions, which reduce overall benchmarkability. So I think overcoming these barriers really requires sustained engagement, regulatory support, which is being provided today, and demonstration of tangible benefits to issuers and investors. And I think you spoke about that. And I think, you know, the beauty about a firm like GCR is we're African. We've been here for 30 years. We understand all the countries, and the methodologies we come up with are factoring into account how the local markets are developing or what is needed for those local markets.
Thank you, Mr. Saurav.
Yeah, I think in the developing or in a new market, the challenges we face is often there is no availability of audited reports, information asymmetry, no peer comparison. I think one of the big thing what even at the regulatory end that needs to come up is a proper audit reports needs to be there. If a particular issuer wants to go to the market, so for the issuer they have to decide whether they want to save on the interest or whether they want to save on the tax. Why I say this, because a lot of issuers they want to downplay on the profit and save on the tax, but then they don't understand that they are losing the ability to attract more capital and at a particular rate. Similarly, information asymmetry, availability, which I think there are a lot of sites now where information can be available. and obviously disclosure of information in the rating rationale, which gives the proper governance which talks about the governance of the company actually.
Thank you, Mr. Saurav. So one of the most important things in the credit rating space is building trust, particularly building trust with investors. Again, I want to get both of your perspectives on this. How important is perceptions of independence and governance in establishing credibility, especially when issuers pay for their own ratings?
Yeah, independence is fundamental. It's non-negotiable. I mean, you know, investors must believe that the opinion is objective, rigorous, and insulated from commercial influence. And this is really key, right? The whole reason why we stand in as rating agencies to provide that transparency and hence non-negotiable. Strong internal governance, clear separation of analytical and commercial functions, which Saurav spoke to, rating committee oversight. And the rating committee oversight and understanding how that takes place is really important because you declare conflicts, you declare any other interests you may have, and voting rights. And regulatory supervision all provide safeguards. Credibility is earned through transparency, consistency, and the ability to withstand pressure, whether from issuers or the market. So for me, independence is fundamental and it's non-negotiable, especially in an environment where you're trying to bring up a capital market. And what is the investor looking for? He's looking for that lens that creates an understanding for them so that they know what risks they're entering into as they make the investment decisions, whether that's retail or it's non-retail.
Thank you, Mr. Saurav.
Yeah, addressing to that, I think the rating agencies are often criticized that it's the issuer who pays for it, so they back the issuer. Thanks to Tanveer, she has already explained on the fundamental ISCO guidelines and fundamental rating committees assigning the rating and all. But then just to bring in, if the investors were paying for the rating, then again the debate will come that rating agencies are favoring the investors and they're giving lower ratings and the issuer has to pay higher cost. So somewhere we need to come into consensus. And for a rating agency, if one investor pays for another rating and the rating is not disclosed in the public domain, another investor comes in, they can charge multiple times to different investors. So at the interest of all the various stakeholders, regulators and all, it always makes sense that if the issuer is coming to the market to raise money, issuer needs to pay. It is part of its overall capital market transaction or or a bond raising or a transaction raising cost, where it is part of the capital market transaction cost, which is not a very high cost. It varies between 5 to 10 bips or maybe 12 bips, maximum 10 bips. It's the cost which if somebody is raising a money and they're able to give that comfort to the investors to save on, another 20, 30 bips, this cost is basically adjusted. Second thing, when an investor pays for the rating, the issuer may or may not give all the information. If the issuer is paying for the rating and they are signing the agreement, then in that case, issuer is obliged to provide the information, not only at the time when the rating is done, but over the period when the instrument is due. And those information coming from the management and get it published in a rating rationale which is validated, that gives a lot of credibility to the rating rationale which are used by the investors. In terms of in terms of setting of confidence, I think we need to, if you're developing a capital market, I think we need to find out issuers who are strong, possibility of default is less, which can help that in the initial period when the investors are coming in, they are seeing that, okay, the market is strong, there are no defaults or accidents, and that can help over the period, that can help in developing a more credible capital market ecosystem.
Thank you very much, Mr. Saurav. I think I'll ask you one more question to part ways. How can companies prepare internally for ratings in terms of governance, audited financials, cash flow visibility? And then to go along with that question, how do rating agencies such as yourself educate these first-time issuers during this process? Ms. Tanveer.
Yeah, so, everything we do is a journey, and therefore it's imperative because what you're currently doing right now is you're giving the bank the ability to do your credit assessment, and you don't know how you score because they don't discuss it with you, and then they decide what limits you would get. Here you're coming to a third party who's completely independent, objective, and trying to give you a clear picture of how your business looks, the shape and the feel. So it starts off with sort of, building blocks, right? The information you talked about is really important: governance, financials, cash flows, MIS, the qualitative aspect of the business, the quantitative aspect. And today, everyone spoke about strong governance and that strong framework. But if you take a step behind, before you start to bring all that information, you really want to understand what's in it for me in terms of how does this shape up, right? You want to strive for a AAA, that's fine, understood. And someone really said it, don't love your transactions because you get emotionally attached. And that's where we come in to give you that reality check to say, these are some of the things you may want to consider. And that starts off with something very simple. You could start off with a credit assessment. A credit assessment is sort of, a point in time reflection of your business. It enables you to see some of the things that you need to get done over a period of time before you come to issuance. Coming to issuance and then doing a rating, that sort of tick box, right? Because an investor's asked for it, a regulator's asked for it, I must get it done. But that's actually you're not investing that money very wisely. You should sort of spend some time to work with the CRAs to see how you can create to shape up some of those 2-3 things that need to be looked at. For example, in Kenya, one of them with the banking industry was around the recapitalization for tier 3 banks, and giving that as part of the credit assessment in terms of within this period of time XYZ should happen. So I think that's really important. But the credit assessment is a nice little building block. But before that comes in what we don't say methodology. Understanding methodologies is really important. Every CRA would have their own methodologies, the weightings, what's important as they go through an insurance versus a structured finance versus a corporate versus, rating for let's say a green bond. So that's really important. And then how does that overlay in terms of your business model? So it's not just about going out and getting a rating, it's also about working with us so that you can, one, understand what goes into it and comes out at the end. And even if there's surprises, you understand why those surprises are good and bad. And the second one is walking through a journey. It's just not a final destination you want to get out to. I think that's sort of really important. And then all of the work that you do with the regulation and the stock exchanges in terms of just promoting awareness around credit ratings.
I think you have summed up very well. Just to add to it, what exactly is a rating agency does is, if an issuer is looking for money and they are going to the investor, the rating agency, and they come to a rating agency beforehand, the rating agency does an assessment and prepares them what an investor is going to look for. So effectively, you are paying a price, yes, but we are doing an assessment and telling you that these are the factors which will be required or which will be asked by the investor. And starting with management, where the governance is there, starting with your business operation, starting with the financials and the projections, and then say that, okay, this is your rating, but the rating again I said, it's the alphabet, but it's not the alphabet which matters, it's a rating rationale. When the rating rationale is given, it's clearly mentioned there what are your strengths, what are your weaknesses, what are the positive and the negative sensitivities that can impact the rating. Now with that rationale, everything prepared, when you go to the investor, I think 60-70% of your job will already be done, because the investor is also looking for similar set of information. While we are not saying that the investor will going to look at it blindly, but investor, when they look into a rating rationale, they try to see and they try to understand that, okay, a good part of the risk is covered, so they know what are the things to look at. Over and above that, a rating agency does a due diligence with the bankers, auditors, site visits and all. That's actually preparing the issuer to face the investor.
Just one last parting shot. So there's a really important distinction when you look at ratings. The first is a local scale rating, which is domestic debt, and that's really important because there, you told me not to bring up sovereign, but that sort of eliminates you from the sovereign space. And then when you talk about foreign currency debt, that's slightly different when you look at international scale ratings. So I just wanted to bring that in because that's really important considerations as you come into the capital markets. And the final one is, even if you're not coming to issuance at any point in time, having an independent credit rating assessment or a CRA do the work for you also allows you to negotiate on your loan market, because you now can go to 3-4 banks and say, you know what, I'm pretty good. I deserve a better price in the loan market. So it's not only for capital markets, it's also for your loan market. And you know, as you start to use, particularly for banks, where you start to use ratings, then there is also capital relief that you could start to get as the central banks come up with models for capital relief and efficiency. So I think there's a lot more than just saying a rating costs a lot, and you know, I just want to use it when I'm coming to an issuance. Thank you.
Thank you so much. Thank you both.
Thank you.
And with that, we close off day one of the second Capital Market Summit. We hope to see you again tomorrow. We're going to make some adjustments and we're going to make sure we are on track, on time tomorrow. So see you tomorrow, everybody. Thank you.